And in this video, we're diving deep into the world of cryptocurrency, specifically, how to book profit like a pro. But holding on for dear life, hoping for the moon, can sometimes leave you with nothing but dust if the market decides to take a turn. It's not just about buying low and selling high, it's about having a solid strategy in place to protect your hard-earned money and actually realize those gains. We're talking about calculated strategies that take the emotion out of trading and help you build long-term wealth. So whether you're just starting out in crypto or you're a seasoned hodler, this video series is packed with actionable advice to help you level up your trading game. Alright, let's kick things off with a strategy that's simple, effective, and perfect for beginners. The 50-50 strategy. Imagine this, you've done your research, you've identified a promising cryptocurrency, and you've invested a portion of your capital. Now, the market starts moving in your favor and your investment doubles in value. Instead of getting greedy and holding on for even bigger gains, you sell 50% of your holdings. By selling half, you're essentially locking in a 100% return on that portion of your investment. But here's the best part, you still have the other half of your investment riding the wave of potential future gains. It takes the emotion out of trading and helps you avoid making impulsive decisions based on fear or greed. The 50-50 strategy is your safety net. Think of it this way, even if the market takes a downturn after you've sold half, you've already recouped your initial investment. The 50-50 strategy is a great starting point for any crypto investor, especially those who are new to the game. Now, let's move on to a more hands-off approach to booking profit using stop-loss and take-profit orders. These are essential tools that every crypto trader should have in their arsenal. They allow you to automate your exits, taking the emotion out of trading and ensuring that you stick to your plan. Let's start with stop-loss orders. A stop-loss order is like an insurance policy for your investments. It's an order that you place on a trading platform to automatically sell your cryptocurrency if the price drops to a certain level. This level is predetermined by you based on your risk tolerance and the specific cryptocurrency you're trading. For example, let's say you buy a cryptocurrency at $100 and you set a stop-loss order at $90. If the price drops to $90, your stop-loss order will automatically trigger and your cryptocurrency will be sold, limiting your potential losses to 10%. Now on the flip side, we have take-profit orders. These are designed to lock in profits when the market is moving in your favor. A take-profit order is an order to automatically sell your cryptocurrency when the price reaches a certain level that you've set. The beauty of stop-loss and take-profit orders is that they allow you to trade with discipline and consistency. By using stop-loss and take-profit orders, you're essentially putting your trading plan on autopilot. This means you can step away from your screen and not worry about missing out on crucial moments. Your trades will be executed according to your preset conditions, giving you peace of mind. Reviewing your trades later, you can see how well your strategy worked without the stress of real-time decision-making. You can always adjust your stop-loss and take-profit levels as the market evolves, ensuring your strategy remains aligned with your goals. This approach not only helps in managing risk, but also in maximizing your potential gains. By automating your exits, you can focus on other aspects of trading, such as researching new opportunities or refining your overall strategy. Ultimately, automating your exits can lead to a more balanced and less stressful trading experience, allowing you to enjoy the benefits of trading without being glued to your screen. Alright, let's dive into another powerful strategy for booking profits in cryptocurrency dollar cost averaging out, or DCA out for short. This method is particularly useful for those who want to mitigate risk and ensure they are capturing gains without the stress of market timing. Now, you've probably heard of dollar cost averaging in, which is a popular strategy for investing in crypto gradually over time. This approach helps investors avoid the pitfalls of market volatility by spreading out their investments. DCA out flips the script and applies the same principle to selling. Instead of making a single, potentially risky decision, you spread out your selling over a period of time. Instead of trying to time the market perfectly and sell all at once, you gradually sell small portions of your holdings over time as the price increases. This way, you can take advantage of the market's upward trends without the anxiety of hitting the peak. Think of it like this. You're not trying to catch the exact top of the market, which is nearly impossible to do consistently. Even seasoned traders find it challenging to predict market peaks accurately. Instead, you're securing profits along the way as the price climbs higher. This method ensures that you are locking in gains at various stages, reducing the risk of missing out on profits if the market suddenly turns. Now, how do you actually implement DCA out? Well, it's all about setting a predetermined schedule and sticking to it. Consistency is key here as it helps you stay disciplined and avoid emotional decision-making. For example, you could decide to sell 10% of your holdings every time the price increases by 20%. This structured approach allows you to systematically reduce your exposure while capturing gains. This gradual approach to selling offers several key advantages. It not only helps in managing risk, but also in maintaining a balanced portfolio. First, it reduces the pressure of trying to time the market perfectly. Market timing can be incredibly stressful and often leads to poor decision-making. DCA out takes the guesswork out of the equation and allows you to secure profits consistently as the price rises. By following this strategy, you can enjoy the benefits of a rising market without the constant worry of when to sell. Let's explore a strategy that's all about maximizing your returns and minimizing your risk, the rule of multiples. This strategy is based on a simple yet powerful principle. When your investment doubles in value, sell enough to recover your initial capital. The remaining holdings then become pure profit, allowing you to ride potential future gains with minimal downside risk. Now let's break down how it works with an example. Let's say you invest $1,000 in a promising cryptocurrency. The market heats up, and your investment doubles in value to $2,000. According to the rule of multiples, you would sell $1,000 worth of your holdings, which is the amount of your initial investment. The remaining $1,000 that you still hold becomes pure profit. The key is to find a balance between securing profits and allowing for potential future growth. Alright, let's talk about a crucial aspect of successful crypto trading: setting profit targets. This is a fundamental strategy that can make or break your trading experience. Now, it's easy to get caught up in the hype and excitement of the market, especially when you see those green candles pumping. The thrill of watching your investments grow can be intoxicating, but without clear profit targets in mind, it's easy to get greedy, hold on for too long, and potentially miss out on opportunities to secure gains. Greed can cloud your judgment and lead to missed opportunities. Setting profit targets is all about having a plan before you enter a trade. It's about being prepared and knowing exactly what you want to achieve. It's about deciding on a specific percentage gain that you're aiming for, and then sticking to your guns regardless of what the market does. This requires discipline and a clear understanding of your goals. For example, you might decide that you're happy with a 20% profit on your investment. This target should be realistic and based on thorough analysis. Once your investment reaches that target, you sell and lock in those gains. This ensures that you secure your profits and avoid the risk of losing them. The beauty of setting profit targets is that it takes the emotion out of trading. Emotions can be a trader's worst enemy, leading to impulsive and often regrettable decisions. When you have a predetermined exit point in mind, you're less likely to make impulsive decisions based on fear or greed. This helps you stay focused and rational. Setting profit targets is about sticking to your plan and not chasing those what-ifs. It's about being consistent and disciplined in your approach. So, before you hit that buy button, take some time to determine your profit targets. This small step can make a big difference in your trading success, helping you stay on track and achieve your financial goals. So there you have it. Those are my top 5 strategies for booking profits in the cryptocurrency market. Remember, successfully navigating the world of crypto is not just about buying low and selling high. It's about having a solid plan in place to protect your investments and actually realize those gains. Whether you choose to implement the 50-50 strategy, master stop loss and take profit orders, or explore the rule of multiples, the key is to find what works best for your risk tolerance and trading style. But this is just the beginning. In the upcoming videos in this series, we'll be diving deeper into more advanced strategies, exploring technical analysis tools, and sharing even more tips and tricks to help you become a more profitable crypto trader. Make sure you're subscribed and have that notification bell turned on so you don't miss out on the next installment. Until then, happy trading, and as always, I'm here to help you build that wealth.